What's going on, guys? Welcome back to another video. So in this one, we're going to be going over the overall state of the market right now, some data that came out today, and the overall price action that we are seeing that is really bad for where these types of situations that we are seeing unfold and where this is going to take us in the future. Now, we're seeing mortgage rates start to climb. The labor market is not softening as the Fed would like it to, which is really giving a key indication on where rates are going to go and stay for the foreseeable future. So again, guys, prepare yourselves for a lot of volatility coming in the near future. We do not have that light at the end of the tunnel, but there are a lot of ways to make money off of this volatility that we are seeing every single day. So before we get into all of that information here, if you do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who actually want to learn. And again, if you do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's get right into the charts over here and take a look at exactly what the market is doing today. So 2 days ago, we just breached a new 52-week low. Yesterday, the Bank of England announced that they were going to be enacting some quantitative easing policies. It's more so quantitative confusion, where they're still going to be increasing interest rates, but they're also going to be buying their bonds in order to try and suppress their bond yields, which again is not going to help with the inflationary pressures that are happening in every single market right now. And today, the market is back down about 2.73%. If you guys were with me in any one of the streams that I was doing yesterday, well, we were talking about the fact that this move up, yes, that quantitative easing news is news that can push markets higher, but the reasons and the kind of the overall implications of moves like that from the Bank of England signal more problems that are actually happening in the market right now, and is literally just putting a band-aid on a bullet hole wound. So again, these moves down, we were all prepared for these. And again, you've seen this cross down here. We do have these new levels of support, but below here, we'd have to go all the way back until, let's see here, essentially November, December of 2020, where we were trading at these lows previously. The market right now, in my opinion, has a long way to come down before we are ever going to see any sort of exuberance in any kind of bounce. Again, now we are in a bear market. There is really no debating that. And we also are in a recession here, and we're going to take a look a little bit exactly some of the statements that were made now about the recession that we are in, and some of the statements that were made prior to the previous recession here. And again, I do want to give a quick shout out to all of our members over here, absolutely crushing it with Pythagoras, Invictus, all of these proprietary trading algorithms that are revolutionizing the way that retail investors are trading. We have a $6,000 gain here, 5.36% on the day here. Netty's up 71% on the week. Again, guys, if you are looking for the best place to come and learn how to trade, you found it. Make sure you check out that link down below. Now, again, when we take a look at some of these other key indexes here in ETFs that are going to track some of the key things, the dollar and the 10-year treasury, well, the dollar is actually slipping today, which is a very interesting move, seeing that the markets are down as well. Typically, if you are to see the dollar actually come down, you would expect to see markets come up. 10-year treasury as well, we throw this back on the 5-minute time frame here, is slipping to the downside again today with this Bank of England news. Now, when we come over and take a look at some of the data that occurred today and was actually released, this is the data that really spooked the market today. Now, a lot of people were paying attention to the GDP data, but that's really backward looking. We already have an indication of what was happening with Q2 GDP. Me personally, I'm looking more towards the Q3 numbers that are going to be coming out mid to late October to give us an indication of, well, how did our growth or lack of growth fare in that time frame? But this is what was really causing market movements today. Powell's plan is not working. Initial jobless claims plunged to 5-month lows. Well, this is not going to help fight inflation. The number of Americans filing for jobless benefits for the first time dropped back below 200,000 last week, 193,000, the lowest number since April. When you think about these job numbers here, very simply, it is good that people have jobs right now in the overall marketplace because they are able to make money, contribute to the overall growth of the economy, and then spend money on any discretionary items. The problem is that if all of these individuals are essentially following along with average hourly earnings, they are making more money. It provides more demand to push inflation to the overall market. Now, we were talking about this in the live stream last night, where we essentially know where things are going to head here. The people who make the least amount in our country here are going to be the ones that get hurt the most, or the first ones to get let through the door and laid off when these layoffs are going to happen. But when you see numbers like this, when initial jobless claims or the jobless claims numbers are actually going down, it means that people are still participating in the workforce at high rates, and it gives the Fed more wiggle room to raise interest rates more and keep them elevated for a longer period of time. That is what the market is reacting on today. They are assuming, well, if the labor market is not softening at all, well, then the Fed can come in and really doesn't have anything holding it back from greater increases in interest rates and actually holding those interest rates at those higher levels. So let's bring this back over here and go over a couple of other things that I think are very important. So again, remember, we did get that GDP data this morning as well, negative 0.6%. What is a recession? While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Instead, both official determinations of recessions and economists' assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on these data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. Now, this has been the narrative that the White House and a lot of the regulatory bodies have been kind of spewing out to the everyday American people, but I want to bring you guys back to this right here. Check the date on this article here, January 17th, 2008. Bernanke, the Fed is not forecasting a recession. The Federal Reserve Chairman Ben Bernanke on Thursday told lawmakers that even though the U.S. economy is facing a difficult combination of circumstances, the Fed is not forecasting a recession. What ended up happening after? A very significant recession. So you have to understand these types of things that are happening in the market right now, and nothing is pointing towards any light at the end of the tunnel anytime soon. Now, the other thing that we need to talk about very quickly before we wrap this video up here is mortgage rates. Mortgage rates surged for the 6th week in a row, moving closer to 6%. The 30-year fixed rate mortgage averaged 6.7% in the week ending September 29th, up from 6.29% the week before, according to Freddie Mac. That's the highest level since July 2007. Now remember, if you guys have been paying attention to any of the videos that we have been making over the last couple of weeks, when mortgage rates go up, essentially mortgage payments are going to go up as well, and people who could previously qualify for X amount of a loan can no longer qualify. It takes the demand out of that side and that price point in the market, and that's when you see home prices start to fall. Now, we just started to see this week. I believe in the first time in about 12 years, home prices have fallen month over month. So you are starting to see things crack. Now, again, if you're on an adjustable rate, this is going to cause some problems for you. If you have a home equity line of credit or a HELOC out there, those are adjustable rates. So those could put some more pressure on everyday people as well. But what you have to realize is at the end of the day, this is coming to a pivotal point where the Fed is essentially handcuffed in the things that they can do, and the markets are not reacting to the things in the way that they necessarily need to be. What the Fed really needs to do here is essentially rip off the Band-Aid, try and accomplish this soft landing, even though it's going to be a very, very difficult task, in order to return to some form of normalcy in the United States economy right now. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening. I'll see you guys in the next one. Peace.